You know, you look at all these conditions, and we do a lot of historical analysis, and when we see the types of reversals that we had, and we see the types of oversold conditions that we had, and we see breadth readings the way they were, if you look a year out, you tend to see better than average returns going forward. And so that's why we've been starting to like nibble and find some stocks that look interesting here. But in the shorter term, every one of these periods, like the periods that you go back to, September 2001, July 2002, October 2008, July 2010, August 2011, January 2016.
Right.
All those periods, we saw similar conditions, but those at that time we saw those conditions, we ended up seeing a lower low. So what we want to see going forward is we want to see if we do see a lower low. We want to see some of these internals show less baby out with the bathwater.
Is there a pattern to those lower lows? In other words, does it take days, or is it a process that may take months or maybe even years?
Well, so I wouldn't say years.
Okay.
I would say it's weeks to months. So 2016, we saw it in January. We saw the low just a few weeks later when Jamie Dimon, the diamond bottom, they called it. In October 2008, it took till March 2009 till we ended up seeing the ultimate low. So if you have a strong stomach, I think you can start to nibble here. We have sentiment that's gotten completely washed out. And valuations, we're going into a year 2019, which is the first year in a while where we've been able to say the valuations aren't above average. You know, so right now we have average valuations, so relatively attractive here. And unless you think we're going to go into an imminent recession, which we don't necessarily think at this point, that there's more evidence pointing towards a slowdown than there is a recession at this point.
Speaking of valuations, Intel's forward PE is 9.5 times right now.
Right.
Are there places you think are attractive here?
Well, so that's one of the names. So what we're looking at, and we're looking for names, is stocks and sectors that led us on the way down, that were faltering earlier this year when the market was doing great, that are now showing signs of stabilizing and aren't making lower lows. So Intel's one of those names. It pays over a 2% dividend. It was faltering even before the semis started to falter. It hasn't gone on to make a new low in this most recent leg lower. So that's one name. Another name, Pulte Homes, the home builders, let us down. And that Pulte Homes is actually up considerably since its lows in October. So that's another name, almost a 2% yield. And the third name along that lines is emerging markets. The EEM hasn't gone on to make a new low. It led us on the way lower. It's been below its 200-day moving average for 140 trading days. That's happened two other times, 2008 and 2016. A year later, EEM was up 75%.
I think EM should go away as an investing class at this point.
Right.
I mean, it's decades since the financial crisis has been, its performance in the decades since then has been woeful. And what is it really? Do you think people can truly make money in this emerging markets thing over time?
I think you certainly can, and it's just what's going to happen is if we do see the Fed start to take its foot off the gas and start to ease a little bit, that's going to put pressure on the dollar, and that's going to put and that's going to help out emerging markets. And you look back to early 2001 when commodities went on their big boom. Nobody even knew what some of these companies were. You know, the symbol for U.S. Steel, no one knew what that was in 2001. And for about 3 years, it was a great performing stock. So when you see that type of mentality and sentiment that, hey, I mean, who in their right mind would want to invest there? That's maybe a period you want to start getting a little bit interested. And it pays over 2% EEM. Which
sector or subsectors do you think are value traps right now?
So I think as far as value traps are concerned, I mean, we tend to see, you know, the consumer staples sector, I think, has just been, you know, I always think there's cheaper areas of the market, I think, where you can get more growth and have better dividends. I mean, Apple, I think, is more attractive than a lot of consumer staples sector stocks at this point. So, and then along with the tech, Netflix isn't a value stock at this stage, but the company is transforming TV, and it is, on our surveys, it is by far the most popular streaming service, and most importantly, they have pricing power. So when we ask people what they're willing to pay for Netflix subscriptions, they could raise monthly prices by $3 a month easy and not see much.
So you don't care that it's still trading at 60 times forward earnings or something like that?
So most of these stocks we were talking about are pretty cheap, 10 times earnings, Intel, Pulte. Netflix isn't very cheap.
It's cheap for Netflix, but yeah, not for everybody else.
Right.